Welcome to Westminster College Center for Financial Wellness. This class is an overview of types of firms or types of businesses. There are several factors that need to be taken into consideration when you're determining how to form a business. The best place to start is by creating or reviewing your business plan. Then you'll have a good beginning to start asking some questions about the type of work that's going to be done in your business, your goals for the business. So which factors are most important will be unique for each company. For example, if you're a bungee jumping service provider, you're going to have high liability, right? So liability risk will probably be a big factor in choosing your business firm type. You may want to grow the company to a global scale. So perhaps accessibility to capital markets is going to be a really important aspect. So again, draw up or review your business plan and remember to consider long-term goals, not just what you're doing today or what the business is like today. We will review a few basic firm types: proprietorships, partnerships, that includes LPs or LLPs. LLCs, which are limited liability corporations, and then two forms of corporations, C Corps and S Corps. Again, while there are many factors to consider, we will review these business types focusing on the following factors: taxation, liability, risk, formation of the business, how to do it, transferability of the ownership of the business, and then access to capital markets. All right, first up, a proprietorship is a business owned by just one person. In fact, the business and the person are inseparable. The person is the business. If you understand that, then it's easy to understand the proprietorship based on the factors that we'll be reviewing. All right, for taxation, the business's net income or loss is passed through and included on the owner's personal tax return. There will be a Schedule C filed with, along with their Form 1040. Liability, so the owner has unlimited personal liability for the business because the person is the business. Okay, so this means if the business is liable for something, the creditor or the plaintiff can go after not only the business assets, but also the proprietor's personal assets, like their house, their cars, whatever. Formation, little formality and little cost. Even if you haven't filed any forms to create a business and you are now providing a service or a product, you are on your own a sole proprietor. Okay, transferability. Sole proprietorship lasts as long as the owner continues to run the business, or as long as they're alive. The business can be sold, but as a proprietorship, if the ownership changes in any way, the old business form is gone and a new business is formed based on whatever the new business structure is going to be. All right, capital. Since you are the business, you are limited to your personal capital. No other person or entity can have ownership of your proprietorship. One other con to a proprietorship is that they tend to be subject to audits at a higher rate than some of the other forms of businesses that we'll talk about. Okay, partnership, sometimes called a general partnership, is similar to a proprietorship, except there is more than one owner. These owners do not have to be people. They can be corporations or a combination of people and corporations. Okay, similar to a proprietorship, the partnership is not a separate entity from its owners. So we have some of the same risks and benefits as a proprietorship has. Since there is more than one owner, it is important to create a partnership agreement. This is a document that lists out important aspects of the company. So topics like management responsibility, as well as profit distribution and expense allocation between the partners, is spelled out. All right, taxation. We have pass-through taxation for partnerships too, basically. The partner's share of the business income or loss is included on the partner's personal tax returns. And if there's a Form 1065 that will be filed by the partnership to the IRS to report the partnership's profit and loss. But taxation is through the partners themselves. Liability, again, each owner has unlimited liability, personal liability for the business. Just like for proprietorship, the owner's personal assets can be used to remedy a lawsuit or pay debts. Formation, little formality and little cost, but again, a partnership agreement is advisable and sometimes required, depending on the state. Transferability, a partnership lasts again as long as the partnership partners continue to run the business. The partnership agreement should cover how the business continues if a partner exits, or if our partner dies, or if another partner is going to be accepted. Sometimes all partners have to agree to changes, and so that makes this transferability somewhat limiting. Access to capital is limited to your partners. Okay, limited partnerships or limited liability partnerships, LPs or LLPs, they're kind of similar. Okay, LPs and LLPs have general partners and limited partners. The general partners are just the same as the partners in a general partnership. The limited partners are different in that they are not personally liable for business liabilities. Okay, some states only allow specific types of companies to form as an LLP, like law firms, things like that. So you have to look into that. And again, a partnership agreement is essential when creating a limited partnership. Who manages what, how distributions are made, etc. Okay, taxation. Each partner will include their portion of the business's net income or loss on their personal tax returns. And then an annual information form for the partnership is filed with the IRS again. Liability. General partners have unlimited personal liability, just like proprietorships and partnerships. The limited partners provide capital and have liability limited to the amount of capital they've provided. So their personal assets are not at risk. These limited partners cannot participate in managing the business though. Okay. Formation of an LLP or LP requires some filings with your state, but relatively simple. Transferability, the partnership again lasts as long as the partners continue running the business. The partnership agreement should cover how the business continues when partners are exiting or new ones are being accepted. Capital is again limited to the partners. Okay, an LLC, a limited liability corporation. Okay, it's similar to a corporation in some ways, while similar to a partnership in other ways. An LLC is considered a type of unincorporated association. It is not a corporation. Similar to a corporation, though, owners have limited personal liability for the debts and actions of the LLC. Owners of an LLC are called members. Since most states do not restrict ownership, members may include individuals, corporations, other LLCs, and foreign entities. So, all right. Taxation. An LLC can choose how the members are taxed, like a proprietorship, a partnership, or a corporation. The default is that it will be taxed like a partnership. So again, business income passes through the business to the LLC members who report their share of the profits or losses on their individual tax returns. Each LLC member may be required to make quarterly estimated payments. And then again, the LLC business itself files an informational return. Liability. Members have limited personal liability for the business's debts or lawsuits. Creditors and plaintiffs usually cannot reach the personal assets of the LLC owners, except in cases of fraud or illegality. Formation. The formation of an LLC requires a filing, usually called articles of incorporation within a state. Transferability. There are varying rules per state, But in general, LLC members' status is not transferable, and an LLC may be required to dissolve with the exit of members, but it kind of depends. Capital, okay, limited to members, but there are no limits on the number of members or what type of entity those members are, as we talked about earlier. Okay, S Corp. Okay, in general, a corporation is a legal entity that is separate and independent from the people who run or own the corporation. So this means that a corporation itself, not the shareholders who own it, is held legally liable for the actions and debts incurred by the business. There are also potentially costly administrative fees to create and maintain a corporation, as well as some more complex tax and legal requirements. So an S Corp is a corporation. Taxation. The business's net income or loss is passed through and included on the shareholder's personal tax returns. Now, this is if, after creating a corporation, they've elected to create it as an S Corp. I'll talk about that in a second, under formation. So I'm assuming that they've elected to create an S Corp. Okay, so the business net income will pass through to the shareholders. If it's an S Corp, the S Corp does file a Form 1120-S to the IRS to report the profit or loss for the S Corp. Liability, the shareholders have limited liability to none of their investments. Okay, under formation, this is where I wanted to talk about how you get to be an S Corp. So the S Corp is created by filing articles of corporation with the state, just like you would for a corporation. And then you file another form called 2553 to be treated as an S Corp. And by doing that, that changes the taxation for the corporation to pass through. So the corporation, as a legal separate entity, does not cease to exist if one or more of its owners die. So remember, a corporation is a separate legal entity. So that's going to impact our transferability and our capital. So transferability, ownership of the corporation can be transferred by sale of stock. So like additional stock can be added either by the corporation selling more stock or by current owners selling some of the stock. Okay, access to capital markets. It's expanded to the public through the sale of stock, but there are some limits. You can have up to 100 shareholders. They have to be US citizens, and there's a couple other things, I think. Those are the big ones. And also the owners cannot be an LLC, a C Corp, an S Corp, or a corporation or a partnership. C Corp. All right. So again, as we talked about with the S Corp, a corporation is a legal entity that's separate and independent from the people who run and own it. All right. And the owners are called shareholders. Didn't mention that with the S Corp. So you start an S Corp and a C Corp the same way. You just make a special election to become an S Corp. If you don't become an S Corp and you're a C corporation, just a normal corporation, you're going to be taxed like this. For federal income tax purposes, a C Corp is recognized as a separate tax-paying entity. So this corporation pays corporate income tax on any corporate profits. So they're business profits. The individuals who own the corporation will pay personal income tax on any corporate profits that are distributed, so dividends, by the corporation to the owners. So if the C Corp doesn't pay dividends, then the owners won't pay taxes on that. But the minute they do, then the owners will also be taxed on the corporate profits. So this creates the issue of double taxation, which is one of the major drawbacks of a C Corp type of business formation. Okay, liability. Shareholders are limited on their liability to their investment. They can lose their investment, basically. Formation, C Corp is created by filing articles of incorporation with the state. The corporation as a separate legal entity does not cease to exist if one or more of its owners die, just like S Corp. And that's going to impact our transferability and our capital. So transferability, ownership is readily transferred via sale of stocks. And then capital is expanded to the public through that sale of stocks. And there are no limits on the number or type of shareholders. So a C Corp has the best access to capital markets. If you're going to have a company that you want to grow very large. All right, that's the end of this course. So you're now ready to take your quiz for this portion, and wish you luck.